Welcome to Sand Compounding. This is Sandeep Anand. Markets can remain irrational longer than you can remain solvent, so said John Keynes. And it's so true when it comes to stock market investing. Stock market returns are never linear, and it is unlike the fixed income securities where you get predefined, pre-committed coupon returns. Let's understand how, because it's a very important concept. So the basic thing to understand here is returns are always non-linear, which means the positive returns can come in few quick spurts within a year or couple of years, and there could be a complete underperformance and the stocks will not move for many years. But end of the day, long term, the stock market will reflect the value of the business as the price. So the returns cannot be deterministic in the short term, because, and even medium term to some extent, because of the market gyrations, and they do not reflect the value of the underlying business in the short term, but in the long term they tend to reflect the value of the underlying businesses. To substantiate this point, I would quote Benjamin Graham, who said, like, in the short run, market is like a voting machine, tallying up which firms are popular and unpopular, but in the long run the market is like a weighing machine, assessing the substance of a company. So that is something which comes through experience for most investors. Most of the people get shocked by the near-term gyrations, and quickly when the market goes down and the prices goes down, people tend to react and get scared and react and sell out the stocks at a lower price and taking and cutting the losses, which is a wrong thing to do. Let's take a case in point here. Let's look at Domino's stock over, like, 5-year period or more than that, right? So typically prices tend to vary a lot, but if you take a chart and plot it out, we see that from 2014 mid onwards, June 2014 till today date, like 2019, the stocks are reflecting over the long term the value of the business. See that there was a sporadic increases for 24 months period between 2016 to 2018, and then there is a complete underperformance for last 1 year. There is no returns. It's literally flat or down over last 1 year. So if an investor invested at the start of by seeing the past performance and invested, now this price could remain like this for even another 2 years. You never know. So there could be a complete underperformance for 3 years, while the past returns showed that the stock had gone up a lot in the last 3 years. So this is where we should not get fooled based on the stock price and market behavior. We should really that's what the famous saying is there, where it says, like, the time in the market is more important than timing the market. So if you stay a long period of time, say like 5 years or 10 years, in this for example in Domino's, you would have made a good returns over these 5 to 7 year or 10 year period. Whereas if you remain invested just for 1 year, look at short term, the prices could go down, and that can influence our behavior, and we can end up selling the stock rather than waiting. So that's why patience is also another important factor in the stock market returns. But always the key takeaway point here is market returns come non-linear, but over long periods of time they catch up with the value. That's some important point we need to take home today. So that brings us to the end of this session. Hope it was helpful.